In the last class, we have studied that what is money, how many types of monies are there, and what types of monies we use in our economy. In the today's session, we are going to study nowadays you are likely to make many of your transactions by the other means. Types of money which is purely promised to pay by someone other than the central bank is called credit money. Your deposit in checking amount. Now let us see with the help of this figure. The liquidity quantium, liquidity quantium, more liquid, less liquid, currency, share of stock, and real estate. In currency, we are checking the account, precious metals. For example, we are doing the transaction with the help of UPI, with the help of Google Pay, Phone Pay, Paytm. These all are the types of the transaction other than money. We are doing the transaction, but we are not using the part of the money which is going to be used. The transaction is going on, and all the transaction is on record. We are not doing the transaction with the help of the money. We are going the online method. Before this UPI, there was the NEFT, RTGS. So these are all the other types of the online transfer amount. Now, items more than one left are more liquid, or in other words, more easily used to purchase something of value. The further to the right on this continuum, the less liquid of the item is currency is as liquid as it gets, and real estate is usually about the most difficult assets to convert the money, seldom taking less than a few months. All the international transactions are done with the help of the gold. For example, India received the dollar and they want to change with the dollar with the money. So what they will do the transaction with the gold. The international currency which all the RBIs and central banks are using is a gold. Do you use money if you use a credit card to make a purchase? No. Why? One is taking out a temporary loan from the credit card company, only one due a month. When you send a check or the electronic transfer to your credit card company from your checking account, you make a money transaction. You all know that what is the credit card. Credit card basically the amount which is given by the bank for the use. For example, we don't have the money and we have the credit card. We can use the credit card for the purchase of the goods. Sometimes what happens, some of the banks give the time limit that if we return the amount within 50 days, then there will be no extra charge. And after that, there will be some percentage of the interest we have to pay to the bank for using the credit card. So these are the different types of the schemes which are taken by the bank and the financial institution for the purchase of the credit card. Sometimes they give the sometimes we can say that they give the different offers in the credit card because they can attract the more people for the purchase of their credit card. Bank deposit and money. Now I have informed you that what is bank, what is money, what is the difference between bank and money, and now what is the relation between bank and money we are going to study. Bank deposit fulfill the criteria for money, store the value, widely accepted in payment, unit of account, but deposit have a different degree of liquidity. Not all can be for the payment. What is bank? Bank is an institution which receive our deposit and which provide us the loan. What happened? If they are depositing our money, they are also giving us the loan. As we are taking the loan from the bank, we are also providing the interest to the bank. So all the income of the bank is depend on the interest. What do we count as our money? Bank is the only institution which can take our saving and provide us the loan. Fragment solution, different monetary aggregate which include bank deposit with different kinds of the maturities. For example, we go for the fixed deposit, we go for the current deposit, and it is a time of the maturity that at the particular time what happened, the amount has been fixed. At that time we can withdraw the amount. The maturity period of the amount has been fixed. Some are FD for 1 year, some FDs for 5 years, some FDs for 10 years. According to the year part, the bank provides a loan to the depositor. Monetary aggregate, the example of the euro area in billion. Cash in circular. In 2009, there is a comparison in this from 2009 to 2019. The banking system. A simplified balance sheet of a commercial bank is as bank reserve fund. Funds are loaned out a private bank but kept is the value cash as a deposit at the central bank. In the most countries, banks are required to keep some shares of the deposit as reserve. This is called a required deposit. In India, we say CRR, cash reserve ratio. Central bank is the father of all the bank. It is providing the head of the institution of all the banks. All the commercial banks and private banks are accountable to the central bank. Now, in India, central bank is RBI. The governor of the RBI is always appointed by the Finance Ministry, Ministry of Finance. How commercial bank earn profit? Government bonds earn interest by lending the money to the nationalized government. Relatively safe and liquid portfolio of loans, funds that are owned to the bank by business, household, non-profit and non-federal level of the government. Less liquid than the government bonds. Major assets and major way to be make earning. Now, for example, it is the recent example which I am going to. The Supreme Court has given the order to the state bank that please clear all the parts of the bonds of the political parties, and how many people has buy the bonds of the political parties, that clearize it on their websites before 15th of March. So it is we can say that it is the recent example of that. Now, types of the bank: legal bank, saving bank, corporate bank, private bank, investment bank, universal bank, and central bank. Banks and their activities have been and still are heavily regulated. Rules about minimum reserve, capital requirement, qualification of the management. After WWII being sealed for interest rate on deposit and loan, USA Banking Act, Glass-Steagall Act of 1933, separation of commercial bank and investment banking. Wave of the deregulation in the 1990s, re-regulation after the financial and economic crisis 2008 and 2009. In 2008 and 9, there is a high rate of the inflation due, and our banking system has been summarized. How commercial bank create money? When a commercial bank decide to make a loan, it credit the amount to the checking account with the store of a key. Deposit money is created. This increase M1. Hence, commercial bank can create money. Yes, the commercial bank and central bank money creation. How commercial bank and central bank create the money? In the Euro area and the other jurisdictions, commercial banks are required to hold a certain share of their deposit as reserves. Bank need to borrow these reserves from the other bank, from the EBC. These reserves do not need to be available at the time when a deposit or a loan is made, but have to be put in the account within a certain time. If commercial bank need cash, then they have to borrow it from the ECB. Central bank, commercial bank A, commercial bank B, and the borrower. With the help of this diagram, I am going to show that how central bank puts its control on the commercial bank. Now we will start money and finance. Function of finance: provision of money to support investment in the real capital, portfolio investment, that is investing funds in securities such as stock or bonds, another form saving and a mean of postponing the consumption, speculative as investment, exploiting changes in the prices to achieve short-term profit, economic impact of risking their own fund is limited, speculative way borrow money in order to explore what they see as market opportunities based on short-term price and movement. Leverage, investment based on borrowed fund. Now, non-bank financial institution, a financial institution that perform a number of services similar to those offered by the bank, but that is a not licensed bank and is not subject to the bank regulators. Our industry that have been growing in size and importance relative to the bank. Activities do not directly affect the money supply. Loan from these entities, unlike transaction using the bank account, are not liquid, non-money assets. Non-bank financial institution, collective investment vehicle or portfolio fund as investment vehicle that pools investment from many different sources, making investment decision for them all as a group. There is index fund, a type of pool fund that tries to replace a common stock or a bond market index, as this fund does not require active management by a manager. Fees as regularly lower than in types of the pool fund. Hedge fund, a type of pool fund that often engage in highly speculative investment and to which access is generally restricted to wealthy clients. Non-bank financial institution, pension fund, a fund with the executive purpose of paying retirement benefits. Insurance company, there are the two types of fund. There is EPF, Employment Provident Fund, PPF, Public Provident Fund. Insurance company, a company that pay to cover all the part of the cost of specific risk against which individual and companies choose to insure themselves. Reinsure, a company that sell insurance to insure companies to share the risk in case of large damage, for example, thought natural disaster. Non-financial bank institution, securities bureau, an agent responsibilities for finding a buyer for the seller of different securities, thereby offering enhanced liquidity to the seller. Building society, a financial institution which collect savings from the consumer and offer them a preferential rates to the other customers so that they can build a residence. Shadow bank, credit intermediation that involve entities and outside the regulator banking system. Modern economics are much more dependent than finance. In the euro area, total financial assets banking sector roughly doubled from 2003 to 2013 and a total of $57 trillion, almost 6 times euro area annual GDP. In the UK and US, financial assets have sustained the equivalent of 10 times of representative national GDP. Financial transaction is even larger. For the US, this value was 700 times GDP already in 2009, primarily a result of rapid growth in high frequently trading. Is too much financial bad for the economy? When economies grow on the basis of mass investment in assets with questionable foundations yet rise in price, the growth is unstable and designated to be short duration. Such irritations, speculative price rises is called bubbles. The did frequently troubled Manager in 1636 to 1637. Different tulip types have different value. Mass spectral, first, only wealth duct were buying them. Even actually, everyone has buying the tulips. Rapid increase in price. Peak March 1637. Some select bulbs sold for the several times the yearly income of a skilled craftsman. Shortly thereafter, confidence in their value is vanished. Almost overnight, the tulip market crashed and many spectacles were run. Stock market bubble 1929, new reality, establishment of the Federal Reserve in 1913, government policies to extend free trade, fight inflation, relaxation and antitrust laws. 1920, everyone is buying the shares. Consumer debt was taken on to buy the stock share instead of consumer goods. October 1929, the stock market crashed. The Great Depression. Since 1970, many other bubbles developed. East Asia 1997, .com stock market bubble 1999 to 2000, housing bubbles in US, UK, Ireland, Spain and other European countries late 2000. Bubbles are characterized by a rapid increase in price that are not generally accomplished by an equally rapid improvement in the economic condition. Buying begets more buying, appreciation in the assets values of trading. Why do we fail to learn from past mistakes? Speculative bubbles from the sociological and economic reason. Sociological reason, faith or blind optimism, herd behavior. Economic reason, easy credit, borrowing for purchase of stock or real estate. inflation of a financial bubble. How exactly are all these possibilities of the bank based on non-bank based finance linked to the macroeconomy? Finance is a crucial to realize investment plan of firms. No saving have to be collected prior to the investment undertaking. Banks create deposit money by extending loan with the stroke of a pen. Investment plan depend on bank and non-bank willingness and ability to provide fund to the firm and household. When and this figure, credit and aggregate demand has been measured with the help of this figure. There is aggregate expenditure and credit volume. Here we more financialized economy, less financialized economy. A larger economy credit distributed tends to let the more aggregate demand. Money is usually borrowed by household and the firm to finance spending on consumer goods, residential property, or new equipments. However, the more finalized an economy, the more of the credit goes into non-productive activities without an impact on aggregate demand for a financialized economy. Therefore, the credit AE curve is further to the left. The international aspect of finance, cross-border trading of financial assets. Some invest of foreign assets because of the good performance. For example, a Japanese car company. Other investment abroad to speculative on the changes in the exchange rate. Trading financial assets across the border means that one country borrow and other country acquires the claim. What to take home? High hyperinflation comes from running the printing press. Deflation is a fall of aggregate price level. Money is a store of value, medium of exchange, and unit of account. Economists definite between the commodity money and fiat money. Commercial bank make profit through collecting deposit and investment in a portfolio of loan as well as miscellaneous securities. Deposit money is created when bank mistakes loan. What taking home? Second, non-bank financial institutions are not subject to the banking regulation. Economics big finalized. Irritational, speculative real estate or asset price rises are called the bubbles. Finance is crucial to realize investment plans of firms. Thank you.